There are three main ways to invest in gold, which I'll outline for you now. Number one, bullion and coins. I always suggest owning at least some physical gold because of its usefulness as a protection of long-term wealth. You can buy physical gold in the form of bars or certain coins. Please note that some coins, known as numismatics, are not only valued for their gold content, but also for their other attributes, like their rarity or their physical condition. It's debatable whether you are investing in gold when you buy a gold coin because it is rare or it has some other feature. Depending on the coin, the premium over the simple gold content may be so high that you're paying much more than what you'd pay for just the gold content of the coin. So please, make sure you are aware of whether the coin you are buying is valued at the gold price or the gold price plus some often exorbitant margin. Gold bars and nuggets come in a wide variety of sizes these days. They can be bought online through the Perth Mint Bullion Store or at bullion dealers in most Australian capital cities. It's probably not realistic for you to hold much physical gold at home safely. However, there are plenty of reputable ways to do so using financial markets and other organisations. These do rely on functioning markets and institutions, so choose carefully. One option is the Perth Mint. This is a fantastic place to keep your gold, except for the fact that it's owned by the Western Australian government. But if you can trust politicians, I suggest looking at the Perth Mint. Option 2 is an institution like Bullion Vault, Gold Money, or one of the many other gold storage companies around the world. I think there's something to be said for keeping your gold stored across different countries, especially outside your home country. Bullion Vault makes this easy, and storage fees, including insurance, are reasonable. Number 2, gold shares. If you have a brokerage account and are used to investing in this way, buying shares in gold companies could be the easiest way for you to invest in gold. But as with any gold investment that isn't bullion kept in your possession, it introduces counterparty risk. Still, this may be the optimal solution for you. If you are heavily invested in the stock market, it's worth noting that gold shares may be a good hedge, meaning they may offset poor performance of your other shares. This worked well for gold investors during the Great Depression. Number 3, ETFs. ETFs may seem like the happy medium between bullion and shares. They have all the attributes of a share, but essentially mimic the gold price. But once you get into the mechanics of an ETF, you begin to encounter all sorts of counterparty risk. Does the fund really have the gold it claims? What if the stock market stops trading the ETF? What if the company that manages the ETF is defrauded? If you would like to buy gold but aren't concerned about these types of questions, then ETF investing is highly practical and will fit in alongside your existing shareholdings. I recommend ETFs that are priced in Australian dollars because this means they include a currency hedge. A currency hedge means that the value of gold in US dollars has been automatically converted to Aussie dollars for an ETF. That's one of the benefits of buying gold ETFs listed in Australia as opposed to overseas exchanges. The reason for this is simple. Gold is priced in US dollars. Australian investors have the double whammy of being exposed to gold price movements and US dollar price fluctuations. While this is part of the risk associated with buying and selling gold, it can add unnecessary complication for investors. By choosing ETFs with a US dollar hedge, the exchange rate has already been calculated for you. In other words, what you see is what you get. This means you don't have to figure out for yourself what the gold ETF is worth in Aussie dollars. Now, in addition to deciding what type of gold you're after, you need to decide how much you're after. This comes down to your risk appetite, particularly your attitude towards diversification. If you have a conservative approach to diversification, I believe you should consider a 10% allocation of your net wealth in gold. If you're more aggressive in your diversification and truly believe in the long-term value of gold, you may want to consider a 20% allocation to gold.